Insurance Basics. An individual disability income (DI) policy covers a person who cannot work because of injury or illness. It replaces some of the income lost due to disability. Occupational versus non-occupational disabilities. Most DI policies only cover non-occupational disabilities, those that arise outside of work. That is because all states require employers to have workers' compensation insurance or equivalent protection for employees. Workers' compensation provides benefits for workers injured on the job. DI policies may cover occupational disabilities for self-employed persons who are not insured by a workers' compensation plan. Benefits tied to income. DI policy benefits are never more than the insured's income or earnings. Otherwise, they might encourage the insured to remain disabled and not to return to work. The insurance helps the insured survive the loss of income while recovering to return to work. Key point: payment of DI benefits depends on these conditions. No DI policy will be issued with benefits that are more than the insured's earnings. No DI benefits will be paid if the insured is not getting regular care from a physician. No DI benefits will be paid without periodic proof of loss. This requirement does not apply if disability is total and permanent. Benefits can be paid as a flat monthly benefit, common with individual policies, or as a percentage of earnings, common in group policies. The higher the benefit, the more the policy costs. Example: here are 3 ways a DI policy may pay benefits. Company A's DI policy pays a monthly benefit of up to 60% of the insured's income. If the insured earned $3,000 each month before a disability, the policy would pay $1,800 per month for total disability. Company B's DI policy pays 100% of the insured's income during the first month and 60% of income thereafter. An insured earning $3,000 each month would receive $3,000 in the first month of eligibility and $1,800 in each subsequent month. Company C's DI policy lets the insured choose a flat monthly benefit amount, such as $500, $1,000, or $2,000. However, in no case can that amount be more than 60% of his or her annual earnings. Qualifying for benefits. Disability income policy benefits are paid if the insured meets the policy's definition of disability. Policies define disability in several ways. A DI policy may cover only total disability, or it can cover both total and partial disability. The definitions of total disability and partial disability also vary. Total disability. Whether an insured is totally disabled depends on the extent to which the injury or illness keeps the insured from working. It may keep the insured from working in his or her usual occupation. It may even keep the insured from working in any occupation. How the policy defines total disability determines whether it will pay a benefit. Own occupation definition. The own occupation, or own OC, definition of total disability favors the insured. Under the own OC definition, the policy pays benefits if the insured cannot work in his or her own occupation due to disability. So, even if the insured can do other work to earn a living, benefits are paid because the insured cannot work in his or her own occupation. A policy with this definition usually costs more because it is easier for the insured to qualify for benefits. It is typically available only in policies sold to professional and white-collar employees. Example: Maria is a surgeon whose DI policy defines total disability according to her own occupation. If her disability prevents her from performing work as a surgeon, even if she can perform another kind of work in the medical profession, the DI policy will pay a benefit. Some own-OC DI policies require that the insured be unable to do all the duties of his or her regular occupation to qualify for benefits. Other policies require only that the insured be unable to do the substantial and material duties of his or her regular occupation. Any occupation definition. The any occupation, or any OC, definition of total disability favors the insurer because the chance of paying a loss is lower. Under the any OC definition, the policy pays benefits if the insured cannot work in any occupation for which he or she has the necessary education, training, or experience. A policy with this definition usually costs less because it is harder for the insured to qualify for benefits. Disability policies sold to blue-collar workers usually use the any occupation definition for total disability. Example: Alfonso is a farmer whose DI policy defines total disability according to any occupation. If his disability prevents him from performing any kind of work in the farming industry, the DI policy will pay a benefit. Because it favors the insurer, disability income insurance using the NEOC definition is easier to qualify for than ONOC coverage. In fact, the ONOC definition of total disability is normally available only in policies sold to professional or white-collar employees, such as lawyers, doctors, engineers, etc. Presumptive total disability. Under the presumption of disability provision, the insured qualifies for the full benefit by suffering a specified loss that is considered total and permanently disabling. Insureds who qualify for these benefits do not need to stay under the care of a physician or give periodic proof of loss to the insurer. These disabilities are presumed total and permanent. Quadriplegia and paraplegia. Loss of eyesight. Loss of speech. Loss of any two limbs. Partial disability. To encourage insureds to return to work, many policies include a partial disability benefit, also called a recovery benefit. This reduced benefit is paid to insureds who have been getting benefits for total disability and are returning to work on a partial basis. Partial disability income benefits are a percentage of the full benefit amount. Example: David was receiving total disability benefits of $3,000 per month before returning to work on a partial basis. If he earned $5,000 per month before total disability and now earns $2,000 per month upon the partial return to work, the ratio of lost income, $3,000, to pre-disability income, $5,000, is 60%, $3,000/$5,000 equals 60%. Multiplying the total disability benefit, $3,000, by 60% yields a partial disability benefit of $1,800 per month. Flat payments for partial disability. Like the standard partial disability benefit, the flat benefit is paid only if the insured has returned to partial employment after a total disability. But while the partial disability benefit pays a percentage of the total disability benefit, the flat benefit simply pays a flat amount, typically 50% of the total disability benefit. Residual disability benefit. While the partial disability benefit is paid if the insured is recovering from a total disability, the residual disability benefit is paid if the insured has a less than total disability that leads to reduced employment and earnings. It supplements the residual income the insured continues to earn. Example: a teacher who earns $4,000 each month suffers an injury that requires her to take a position. It pays 60% of her usual salary. She will now earn $2,400 each month. A residual disability benefit will make up for the lost income by paying 40% of the policy's total disability benefit. If the total disability benefit is $3,000 per month, she will get a monthly benefit of 40% of that total disability benefit, or $1,200 per month. $3,000 times 40% equals $1,200. This benefit continues as long as the insured loses at least 20% of pre-disability earnings due to the disability. If the income loss drops below this limit, benefits end. So, benefits are calculated monthly and adjusted whenever the insured's residual income increases or decreases. These benefits can continue for as long as the policy's maximum benefit period allows. Other types of individual disability income policies. Two other forms of individual disability income insurance are pure loss of income, income replacement, contracts. Individual credit disability insurance. Pure loss of income, income replacement, contracts. Income replacement policies are a type of traditional DI policy. They pay a benefit if the insured becomes disabled and cannot work in his or her occupation and works at another, less demanding, job and earns less income. If an insured is totally disabled but goes to work in another occupation, this policy pays a benefit based on the amount of income the insured lost by working at another job. Individual credit disability insurance. A credit company often buys credit disability insurance to protect itself in case the insured debtor becomes disabled and cannot pay off the loan. The credit company owns the policy and will get the benefit payments if the insured is disabled. The benefit period is the same as the loan period. The benefits match the loan balance. So, if the insured becomes disabled during the policy period, the policy pays benefits equal to the loan payments that come due while the insured is disabled. For your review, most DI policies only cover non-occupational disabilities. A DI policy will not pay a benefit that is more than the insured's pre-disability earnings. DI benefits are not paid unless the insured gets regular care from a physician and gives periodic proof of loss. This requirement does not apply if the disability is total. A flat benefit is common with individual policies. In group policies, a benefit is based on a percentage of earnings. Under the ONOC definition of total disability, benefits are paid if the insured cannot work in his or her own occupation due to injury or sickness. Under the NEOC definition of total disability, policy benefits are paid if the insured cannot work in any occupation for which he or she has the necessary education, training, or experience. Insureds who qualify for presumptive disability benefits do not need to be under a physician's care or give periodic proof of loss to the insurer. The partial disability benefit pays a reduced benefit to insureds who have been getting benefits for total disability and are returning to work on a partial basis. The residual benefit is paid to an insured who has a less than total disability that reduces employment and earnings. It supplements the income that the partially disabled insured is able to earn. When the disabled insured's income loss is less than 20% of pre-disability earnings, residual disability benefits usually end. Please pause the audio and watch the video. You can restart the audio play.
I tend to think of medical expense insurance as their most important coverage. If they understood the risk of becoming disabled and losing the ability to earn an income, they might rethink that position. Disability is sometimes called a living death. And besides the obvious misery that goes with being disabled, this is especially descriptive from a financial perspective. As with death, the disability of a wage earner means that that person can no longer provide an income to his dependents. Unlike death, a disabled person continues to use family resources, and thus, in a way, disability is even more expensive than death to a family. Like most forms of health insurance, disability income insurance is available through individual and group insurance products. This lesson looks at individual disability income policies. Now, as you review the details of this lesson, focus on the distinction between what we call the NEOC provision or definition of total disability and the ONOC or own occupation definition. If you understand that distinction, it'll help bring a lot of the other details into focus. Quite simply, the own occupation or ONOC definition of total disability is the more attractive of the two definitions from the policy owner's perspective. It also is a little bit more expensive, as you'll see why in a moment. With the own occupation definition, policy benefits are payable if the insured is disabled and unable to engage in the duties of his or her own specific occupation. Let me give you an example. Let's say we have a surgeon, a brain surgeon, and this brain surgeon is in his hobby shop one day building a birdhouse for his daughter, and as he's hammering away, he brings the hammer down on his left hand, permanently damaging some nerves in it. After a week or two of rehabilitation, he's basically okay, except that he will never have full use of his left hand again. Now, to you and I, that might not seem like a total disability, but if you're a brain surgeon, the loss of ability to use your left hand prevents you from doing brain surgery, at least on my brain. And under the own occupation definition of disability, because he cannot perform the duties of his specific job, he would qualify for benefits. Now, see how that compares to the NEOC definition. Under the any occupation definition of total disability, a person is considered totally disabled and eligible for benefits only if they are so disabled that they are unable to engage in any occupation for which they're reasonably suited by reason of training and experience. Going back to our brain surgeon example, if the policy that he had wasn't based on an any occupation definition, he probably would not qualify for benefits. And that's because even though he could not perform brain surgery, there are a lot of other things he could do. He could teach at a medical school. He could, run some functions in their practice. The point is, there are a lot of things that this person could do besides performing brain surgery that would prevent him from being considered totally disabled. As one would imagine, the any occupation definition of total disability is less attractive to the policy owner, it's less expensive, and for practical purposes, the any occupation definition tends to be found in what we consider blue-collar types of positions, policies offered to blue-collar workers, whereas the own occupation definition is pretty limited to the professional worker.
Okay, so here's our 4 questions from the lesson. If you made it this far, congratulations. Jake borrowed $300,000 from Capital Company, buys a credit disability insurance policy equaling the amount of the loan. He suffers an injury that prevents him from working. He is unable to back the loan. To whom will the policy pay the benefit? I have no idea. From ABC Capital, I think. All right. In which statement is correct about the benefit period in a credit disability insurance policy? It is about the same as the loan payment, I'm guessing there, totally. All right, which statement regarding the basics of disability income insurance is correct? And just so you know, you can screenshot these, review this video again, and continuously review these questions until you get them. I do not know the answers in advance. I'm doing this freestyle. In the future, I'd like to do these live, these kinds of tests. But if nobody comments, nobody wants anything live, then it's just going to remain the way it is. But just so you know, you can go back and look at these videos as much as you need to help you with your test. All right, and moving on, which statement regarding the basics of disability income insurance is correct? All right, this individual DI commonly used the percent of income earnings approach. We'll just go with that one because I have no idea. Okay, Andrea earned $3,000 each month before she was injured in an accident. Now she works part-time and earns $1,000 a month. Her disability income policy pays $2,000 monthly for disability. The policy uses a flat rate to determine partial disability. How much will she receive? $2,000. All right, let's see what we had. All right, I got half of them right. And I got the last one wrong, $1,000 for partial disability. $2,000 for total. You got to be careful on the test, by the way, with this. Okay, because this is kind of tricky. See here, it says total disability, but then she's putting in a claim for partial, so that's why it's $1,000. Okay. All right, this was a total guess, and I got it right. A credit disability insurance policy covers the risk of becoming disabled and unable to pay off the loan. Policy's benefit period is the same as the loan period. All right, ABC Company alone will pay the balance of his loan to the creditor. Nice. Wish I could have that on all my loans. Just send the bill to somebody else, please. All right, which statement regarding DI insurance is correct? Okay, the own occupation definition of disability may provide benefits to an insured whose disability permits some form of employment. All right, so that's the correct answer. The flat approach to benefit selection is more common with individual policies. In group policies, the percent of earnings approach is more common. All right, so congratulations to those who have made it to the end of this video. I shall see you on the next one.